prospect of 10 million Bitcoins being bought, it may not be possible at all, like for any amount of money, because, as more people try to do that, the price will go up and then they won't be able to afford to do it. I went to some kind of private meeting, like a bunch of like investors and a few tech people, just like general discussion some years ago. And like a question I asked for the Bitcoin holder or investor or fund manager type of people is like, well, what features would you value most from the technical side for Bitcoin? And their answer was surprising, which was like, just don't break it.
Welcome back to the Freedom Footprint Show, the Bitcoin philosophy show with Knut Svanholm and me, Luke the Pseudo-Finn. For those of you who've been in the Bitcoin space for a while, our guest today needs no introduction. Joining us is none other than Dr. Adam Back, co-founder and CEO of Blockstream, the mind behind HashCash and a true OG Bitcoiner. In today's in-person interview, recorded at Baltic Honeybadger 2023, shoutout HodlHodl, we dive into plenty of important topics. We discover Blockstream's current projects, we explore the developments of Bitcoin second layer solutions, and we debate their use cases after hyperbitcoinization. We even touch on the Drivechain debate. You'll want to hear what Adam has to say about that. But before we jump in, a quick reminder that the best way to support the show is to send us a boost or stream us some sats using a value for value podcasting app such as Fountain. If you're listening to the show as a podcast, check it out on Fountain. You can earn sats from listening and you can support us and all your other favorite shows. You can also support us on Geyser Fund or send sats directly to our Lightning address, freedom@getalby.com. And if you want to exchange your dirty fiat, you can support us on Patreon. All our links are in the description. If you're watching on YouTube, don't forget to like the episode and subscribe to the channel. Even if you're listening as a podcast, head over to our YouTube channel and subscribe to us there. It would be a big help. And finally, we want to thank today's sponsors: Wasabi Wallet, Orange Pill app, The Bitcoin Way, Zelox, and bitcoinbook.shop. All their information is in the description. We'll be talking a bit more about them later. And now, without further ado, here is Adam Back on the Freedom Footprint Show.
Yeah, so a man that needs no introduction. Dr. Adam Back. Welcome to the Freedom Footprint Show. That's the name of our show, right? Yeah. Welcome. This the CEO of Blockstream and mentioned in the white paper and all this stuff. Great. I saw your panel yesterday with about things we don't usually talk about, like price. And there was a couple of takeaways. There was a question during the panel, like, do we have to end the Fed before Bitcoin hits 100K? Which I think is slightly oxymoronic, because if you end the Fed, there are no more dollars. But there was also this amazing observation that you made, that there are now 1 million addresses with 1 Bitcoin or more in them, or like with around 1 Bitcoin, right, in each one of them. So that's 1/21th of 21th, is that a word? Of the entire Bitcoin supply. So, what happens when the next 1 million people want to do that? And yeah, that's good starting topic.
Yeah, I mean, it was a statistic put out a few months ago, probably from Glassnode or one of the analyst companies who are looking at on-chain data. And I thought it was like positive, right? Because there are people like develop a target. So they're, they're dollar cost averaging, or they're buying as they sell things, or get some money together, and they're trying to get to a target of 1 Bitcoin. And now there are 1 million people who got there, or more, I think, is the metric. And so, my initial thought was, well, 1 million is good. That's bullish, but maybe we can do better. Like maybe we can get to 10 million in the future. And I was like, well, wait a minute. That's probably not possible, because there are only 21 million Bitcoin, and many of them are not on the market, right? They've been cold bought and cold stored by people who've already held them for years. They're probably not selling. And the people who just, saved up and managed to buy a whole Bitcoin, they're not going to sell it because that was a target they took some years to achieve, right?
Yeah.
So, prospect of 10 million Bitcoins being bought, it may not be possible at all, like for any amount of money, because, as more people try to do that, the price will go up and then they won't be able to afford to do it.
No, that's Yeah, that's fascinating because like the way I see the volatility in Bitcoin is it's mainly because what Raheem said yesterday, like it comes from the existing stock and not from the flow part of it. So not from the newly minted or newly mined Bitcoins. So the hard thing to know though is what is that ratio? Like how much of the liquidity comes from the existing stock and how much is the newly mined Bitcoins?
Yeah, I mean, there are a few like positive reinforcements. So one is, well, they could be negative in a down sense as well, is the miners. So, you know, many of the miners are like prop miners, people mining for themselves with a company, either public company or private company or individuals with, you know, a garage full of miners. So they're trying to actually keep the coins, right? But they're having to pay the power bills. And typically what they do is just spend all their money on miners, and then they sell a portion of the Bitcoin to pay for the power bill and their operation costs. And in a bull market, you know, maybe they can keep 50, 70% of the coins they mine, and that's good. But in a bear market, they may have to sell 70% of the coins just to pay the power bill, so they're not keeping much, right? But as soon as the price starts to go up faster than the hash rate can grow, then they start selling less. And so they take coins that were like regularly being sold on the market, they take them off the market. And so it's kind of an effect, a bit like a halving, sort of a boost to, you know, it creates some price momentum, right? So if price goes up for some random reason, some good news or like a string of positive media coverage or something like that, then the miners will stop selling as much and it'll boost the price further because now there's suddenly less coins for sale, right? So that's a kind of positive reinforcement.
So do you expect a like Heinz ketchup type moment during the next cycle where there's not as much of a sell-off because there's just too few coins? Like, is there going to be a gradually then suddenly type moment?
I mean, it looks a bit like it because the dollar cost average army is just gradually, you know, it's like a tug of war game where they keep buying every day, and like the coins on exchange are just shrinking and shrinking and shrinking. And like if it gets too low, something explosive is going to happen somewhere, right? Because you can't, like if an exchange gets out of coins, you can't buy coins for any money. You've got to tempt somebody to deposit some coins that they intentionally took off exchange to cold store, like an intent for that to be some time. So the price might have to be quite high before they would do that. So, I think it's interesting, like also it seems like, there are different types of trading activity. One is what I call price formation. So it's people who are, buying for the long term or selling for tactical reasons where they don't have the money to buy them back, right? Like they're a miner and they need to pay off some debts or they have to cover their power bills. So they're not buying them back tomorrow. But then there's a lot of speculation, and that's zero-sum game and doesn't really change the price. It just adds liquidity. And apparently, the price volume is more in the derivatives, like in the sort of perpetual futures, so in the high leverage area these days, right? So that's actually relatively zero-sum, I would say, typically, right? Because it's high leverage.
So, I've heard a statistic from Glassnode that not only are the addresses with one coin or less in them growing in numbers, but also the addresses with 10,000 Bitcoins or more are shrinking in numbers. So the way I see that is this is a redistribution of wealth, really.
Yeah. That sounds like the Gini coefficient is improving, huh? Yeah. It's a little hard to know for sure because, some of the bigger wallets turn out to be exchange balances or funds or custodians that represent many users. And also some of the more privacy conscious users will store their coins and break them up into, hundreds of parts, right? So if they've got 100 Bitcoin, they'll store like one Bitcoin 100 times in different UTXOs. So there's error on both sides, but still I think the public data is useful because it's an indication of a generalized effect.
Yeah, it's hinting at something. Like,
right.
So if you try to extrapolate this far ahead into the future, it's like 2 generations from now, like how big is how big of a portion of the total amount of Bitcoins are going to be squandered away by this, reckless first generation of Bitcoiners that we are? Like, are we going to be able to make up inheritance plans, or like how many Bitcoins will there actually be available in, say, 2050 or 2000?
Well, I mean, if they spend them, it's redistribution, right? Because they'll spend them at a business that will either keep them or sell them on the market, which, gives somebody else an opportunity to buy. So
I'm thinking more in boating accident terms, like how reckless
like
are people?
actual like backup failure, inheritance mechanism failure. Yeah, I mean, probably some. I think, the technology is improving slowly. But yeah, I mean, key management is, not that easy, right? I mean, the mechanism is easy enough. You write down the words, you do it on some kind of fireproof thing. Maybe you make multiple, like, so there's redundant backup or 2 or 3 or something, put them in different locations. But I think what's harder is intuition about where is a good place to store it that's still going to be there in like 50 years or 20 years, depending on how old you are, right? Like the physical world suffers bit rot. People's memory is not as good as they imagine it is. So, and some people actually have accidents, like they have a car crash or a boat, like literally they lose the backup, or they forget the extra good password they made and didn't use for 5 years or something. So there can be losses too, yeah, for sure.
Yeah. So from one thing to another, what is Blockstream working on right now? What is the current projects there?
Lots of things. So we're working on Lightning. So we have this protocol called Greenlight, which is a kind of client. So when a Lightning wallet interacts with the Lightning network, it does certain network things, right? It syncs with a gossip network, which gives it a map of the network. It's a source routed protocol, so each client needs to know the full map of how to route to other people. And it does various kinds of network information to keep up with the network, understand which routes are reliable and things like that. So there's a certain amount of overhead. And you can think about that as the kind of analog of a full node wallet, like Bitcoin Core, right? So yeah, you've got the full node kind of Bitcoin wallet and a full node Lightning wallet. And then there are sort of client server modes where, you trust a custodian and it runs the node, or you have remote control wallets where you run a node and then your phone wallet actually remote controls it. It's a kind of remote control wallet. But so Greenlight is another kind of protocol which is still self-custodial. You have your keys and you verify the information you get from the network. And so you have a good degree of security that somebody can't trick you into spending the money in a way you didn't expect. But it's sort of server assisted. And so it makes a much lighter client. The client doesn't need to sync as much data. It doesn't need as much storage. It can connect to the network, reconnect to the network after being offline for a few days and immediately transact with high reliability. And a normal, like full node type of Lightning wallet will sync a lot of data and analyze it before it can do that. So it makes a sort of lower bandwidth, lower storage, faster, more reliable Lightning wallet, basically. And so we've worked with a few companies. So Breeze is adopting that as a protocol, and we're integrating it into the Green wallet too. And that's available in a kind of early access beta program and should be live as well soon. So that's interesting for like recent developments in Lightning. And from Core Lightning, which is the implementation of Blockstream works on, and there are lots of open source contributors as well. And we have some kind of user interface to control a node. So if you do run a Core Lightning node, there's a user interface to So you'd have to like command line, change the configuration as the user interface for it. And that's been, it was already on Umbrel. And now it's available on Start9 as well, which is another kind of Bitcoin full node where you can install apps. And so there's a new app, which is Core Lightning with a user interface. And so there are a number of interesting developments between sort of this evolution of Lightning becoming a bridging protocol between other layer 2s. So there's another company called Bolts, which is doing submarine swaps. So kind of trustless swap historically between a Bitcoin UTXO and a Lightning channel balance. So if you're a merchant and you're selling a lot of things and you've got, a lot of Bitcoin stacked up on a Lightning channel, you can swap it with Bolts. It will give you a UTXO on chain, and then you'll get your capacity back. So you're ready to accept more payments. So you can use it to take capacity out, or you can do the opposite. As a user, you can use it to buy capacity. And so you pay them a UTXO and they add balance. And with the sort of rapid increase in on-chain fees from, the ordinals and inscriptors and all that stuff, it created an actual problem for them. They were having trouble making these transactions complete and reliability. And so in a very short period of time, like in a week or two, they implemented a submarine swap between liquid Bitcoin, so on a liquid sidechain layer 2, and Lightning. So now you could rebalance an on-chain Lightning channel using a different layer 2 Bitcoin, liquid Bitcoin. And it's cheaper, like the liquid is not as congested as the main chain, and it's faster because the blocks are 1 minute and 2 blocks is final. And so then they had a way for you to basically rebalance your Lightning channel. So the same kind of behavior, but using liquid. And even after the fees, the ordinals and inscriptors phase, like that fad faded, I guess, when the fees fell to normal levels, apparently they were saying that the liquid Bitcoin swap remained like a significant proportion of their ongoing swap traffic. So people found that a convenient and faster way to rebalance channels once they got used to it, basically.
So when the wizards broke Bitcoin, so to speak, they actually helped.
Yeah, well, it's interesting because like it seems that there's not so much proactive sort of work by service companies in Bitcoin, like exchanges and wallets and payment providers and swap suppliers. They don't necessarily like proactively plan for what would happen if the fees increase in the future, but when they increase, they take some sort of disaster avoiding action quickly, right? Yeah. And so they just look around for what's the quickest fix, and they'll look at, recent technology developments or things they can do quickly. And this is one of them. So yeah, I mean, actually, we can thank the inscriptions for that, which is they create a fee spike, which made Bitcoin more robust and scalable, right? Because people adopted another kind of technology that offloads capacity draw on a main chain.
It's akin to the lockdowns driving the development of video conferencing apps. Like,
well, here it's good because it means that now there's more UTXO space for cold storage and censorship resistant payments on the main chain because if there are the same number of Lightning channels, you can rebalance them without touching the main chain, which is great, right?
Yeah. And so what about the latest fad, this BIP 300 debate? And like, I won't go into the details of that very thing, but there seems to be this eternal battle between Bitcoin conservatism, if you will, and Bitcoin progressivism. Like, so have we already oscillated? Like, what's your angle on that? Is it worth? Like, how much should we resist change and how much should we push for change, and how hard is it to change it? Like, do you see Bitcoin ever hard forking again? I know there are some issues that need to be resolved, but
yeah, I mean, I think technically most of these are soft forks, and there's a surprising amount you can do with a soft fork. Like, it turns out to be more powerful than people originally thought. But I think nevertheless, the question is, like, historically, Bitcoin has resisted any change that has not got widespread technical consensus, like all the technical people agree it's the best approach to a given like problem or new feature, and that, you know, the ecosystem like it, i.e. the Bitcoin investors like it. Because the way I look at the fork wars is, you know, I think a lot of people, like everybody from different viewpoints learned from it, I think, and weren't sure how that was going to resolve. Some people thought miners had a lot of control, and so they lobbied miners. It turned out they had very little control. Other people thought developers had control, but, you know, the solution didn't involve the developers. And really, it turned out that the market won, you know. So the people that, I mean, I look at like the labor theory of value fallacy, right? If I'm a gold bug and I'm buying gold, and some miners have a revolt over there and decide they're going to dig up some lead and expect me to pay for it because it costs money to dig out of the ground, I'm like, I don't care. I want gold. I don't care how expensive it was to mine the lead. I don't want it. And they're either going to go bankrupt or they're going to stop, right? So I think that is ultimately what happened with, you know, with this fork drama, which is that, you know, the miners and the people lobbying them were philosophically wanting to make a different trade-off for Bitcoin, sort of dilute Bitcoin's immutability and censorship resistance and like decentralized robustness, trade that off for some cheaper like on-chain transactions. Yeah. And the investors said, no, we don't want that. And they have a way to assay the digital gold, which they run a full node. And if you mine something they don't like, it's automatic. They don't even see it, right? And they certainly won't accept it. So, and they set the price. So, you know, the miners will just, it turned out, will mine whatever is more profitable to mine when it comes to the crunch, right? So now, I do think the concept of Bitcoin immutability or ossification is important for long term, because change implies risk, and you know, you want to like reduce risk as more value piles up on Bitcoin. And I mean, if you look at, let's say, other internet things like TCP/IP, basic TCP/IP version 4 hasn't changed materially in decades, right? And like it still interoperates, and it's essentially the same protocol. And so, you know, ideally you'd want Bitcoin layer 1 to be like that after, you know, various limitations are improved. So the question is, what changes minimally need to be there to get to that point? And that's like not so clear because it's still in a bit of R&D. So, you know, I think, you know, like recent opcodes that's been discussed are like APO, so something to make a more efficient variant of Lightning possible, LN symmetry, and APO is any previous out. Another one is covenants, so they're sort of attached to use cases that people think are useful. So, and that the second one, the sort of covenant use case, is attached to vaults. So I think that is a significant improvement in cold storage security, which means that if you have some Bitcoin in a safe and, you know, you go away for a few days and when you come back, the safe's not there anymore, and, you know, somebody's taken it away and like cut it open or something. Yeah. Now you need to be able to undo that transaction and like send the coin somewhere even colder, right? And so a vault enables you to do that and to share the undo transaction with other people. So you could give it, you know, to your friends. It'd be kind of like a anti-kidnapping possibility also, right? Because, you know, if you can give the cancellation instructions and pre-signed transactions to third parties, they can say, well, you know, I can't reach the guy for a couple of days. I'm getting nervous. None of his friends have heard from him. So we're going to cancel all these transactions. And that will kind of, so that's the vault concept. So I think that is quite hard to do properly without, you know, like a covenant like opcode or something.
Couldn't it be done with time locks?
Well, the thing is, you need to sort of, I mean,
you need another variable like.
Yeah, I mean, the effect you want is that you can devault, so I can take some coins out of a vault and they're kind of stuck in a time lock situation where I can spend them with a key I have access to after a week, let's say. And, you know, if I have the keys, I could spend them in a different way, right? in the meantime. And so I need to like pre-sign it with some keys I don't have anymore. So then you have to kind of, I think the best you can do to simulate it is, I have my cold wallet and I pre-sign all the UTXOs and then I delete the keys. It's kind of scary, right? Now my wallet is a bunch of pre-signed transactions and I have to back those up. So that's hard to do with a seed. I have to like back up a lot of data. So it's kind of like adds its own risk. And it's a bit of a difficult trade-off because you are, on the one hand, trying to have a good backup of the keys until you use them. On the other hand, trying to be very sure you've deleted them so that you can't override your vault mechanism. So it's kind of a bit of a conflict. So it's hard to get to do it in a robust and like reliable way. Whereas a vault can do it because you can, write a covenant allows you to write a sort of restriction, which is to say, well, I have the keys, but the coins are set so that I'm not able to spend them unless I spend them like this. And so you can add the devaulting as a restriction on the coins. And then you don't need to delete keys, basically. So that's the
okay.
Yeah. So you can simulate it, but not that well. And like covenants also, most Bitcoin opcodes are very low level. It's kind of like a machine instructions in a CPU. It doesn't do very much. Like each opcode is like, push a number on a stack or add two numbers together or verify a signature. They're like very low level things. And so a vault is like, the covenants are a bit like that. It requires a certain structure in the output transaction. So it's a relatively simple thing. And so of course, once you have it, you can do other things with it as well, right?
All right. So, So what separates Liquid from these other proposed sidechains and Drivechains and whatnot? Like what's the key difference?
Yeah, so Liquid is the sort of sidechain you can build without new opcodes. So the way it works is there's a federation. So a number of exchanges and service providers operating a hardware security module that is, participating in the Liquid network. So they're running a Liquid full node, which is a kind of extended version of Bitcoin protocol. So like Liquid sidechain is Bitcoin plus some extensions, basically, right? And then and from the Bitcoin's perspective, the coins look like they're in a big multisig. And these hardware security modules will, accept coins in and let people claim them on Liquid as Liquid Bitcoin. And if on the Liquid side, somebody requests to peg them out or like freeze them or burn them on Liquid and request them back on the Bitcoin side, then the hardware security modules will sign to follow that instruction and give it back to somebody on Bitcoin. So it has, it's not as censorship resistant or like and not as good a place to do cold storage as Bitcoin, but for its kind of general purpose of like medium-sized transactions, short-term trading or transacting, but it has some advantages. So for example, one of the extensions is stable coins, so you can have other assets. And so that's convenient because now you can do kind of limit orders and atomic swaps between, different assets. Whereas on Bitcoin, there's only one asset, it's Bitcoin, right? So you get that. And so the difference is really that, if something goes wrong on Liquid, Bitcoin doesn't really know or care about it. All it sees is a multisig, right? Whereas I think there are a few different types of merge mine sidechain ideas. The original one involved fraud proofs. The idea there was with the merge mining, there would be, the Bitcoin miners would be also hashing the sidechain. So they wouldn't like look at the sidechain to see if it's valid necessarily, but they would like put a timestamp on it or something, right? So
the dedicate hashing power to it?
Yeah, it's merge mines. So, they mine Bitcoin and then they put the checksum of the most recent sidechain block into the main Bitcoin block. But it doesn't, if the sidechain like has a bug and forks, like experimental or something, it won't fork the Bitcoin network. They can ignore it. And typically the sidechain could be, the Bitcoin chain can be progressing forwards, processing transactions, adding new blocks, while the merge mining is doing a reorg, like undoing a transaction or orphaning something that was a mistake on a sidechain. So there's not really any pressure on a sidechain to want to undo Bitcoin blocks just to undo something on a sidechain. Because that's one of the concerns, right? It's like they get a lot of economic activity on a sidechain and something goes wrong and then they desperately want to undo it. And then they come and try to plead with the miners to pay them to undo the whole chain, right? And you want Bitcoin to like never go backwards.
So you don't want people to shitcoin on Bitcoin, right?
Yeah, well, I mean, you don't want to import the incentive to undo mistakes onto Bitcoin. It's just kind of like Ethereum, right? They made some god-awful mess. They like screwed something up big time, and the people affected financially were the insiders, and so they like undid a bunch of stuff.
Yeah.
And now there are 2 Ethereums, right? And so, if that was a Bitcoin sidechain and not Ethereum, what would they have come in on one that's tied to Bitcoin, like block height? Now they wanted to undo it? What would they do? Come to the miners and say, could you please undo that? I mean, I think it's very difficult in Bitcoin. People have tried that. Like a number of exchanges have got hacked for large amounts of money, like Bitfinex back in 2015. They resolved it now. They raised the money like a long time ago. So it's long resolved, but at the time people were wondering, and more recently, I think the last year or two, Binance had some hack and they came and tried to talk to developers or miners to say, could you undo it? Like, I mean, not really.
No.
I mean, just imagine the chaos if it was undone, just the accounting costs, because other things could get replayed or double spent if something was redone. It's not remotely worth it.
No. So
it doesn't make any sense.
So it would mess with the incentive structures, basically.
Yeah. So that's one concern. And then a Drivechain. So the original sidechain is like merge mined, and it presents a compact proof to Bitcoin. So it adds a soft fork to Bitcoin. This is the concept, right? To verify a proof that most of the merge mining work, like that there's a certain amount of merge mine work on the sidechain that approves this withdrawal request. So it doesn't verify the whole sidechain, but it can see that, there's a lot of merge mining that seems to be saying that the miners agree that this guy should be able to withdraw this coin. And then there's a time lock, kind of like with Lightning, where somebody else can sort of provide even more work, like a higher block height with something that contradicts the first one. And then they can cancel the withdrawal. It's kind of like a reactive security like Lightning. So that was one version, and a Drivechain is a simplified version. So it has no fraud proofs. It just says, well, they make the peg out slow. And so if the users see coins being stolen by a big conspiracy of miners, they have 3 months or 6 months to do something about it. And if you think about it, the scenario is that there's a conspiracy between most of the miners. So now the users, Bitcoin users and investors can't really get the miners to help prevent that because the miners are already in the conspiracy, right? So now Bitcoin basically has to undertake a UASF-like situation to say that to the miners, look, we're going to block this theft. And if you try to do it anyway, we change the code. If you do it anyway, you're going to fork off the network and we're not going to honor your coins. So don't do it. And that was kind of like what happened with the SegWit activation. And it was a very dramatic and kind of scary thing with a fair bit of risk. So people don't want that kind of risk, right? And so that's the challenge for Drivechains. Like the sort of disincentive to steal is kind of an expensive exercise in risk terms for the main chain. And people don't like risk on the main chain. So that's the problem, I think. Like people wanting to opt into things is generally fine, but if it creates a cost or a risk, then if it starts to be undesirable.
Sounds way easier to just not tamper with it.
Well, I mean, it's interesting. I mean, I think it's always interesting to discuss ideas because by discussing them, people like invent new things or change their perspective. Because I think before like the last few weeks of Drivechain discussion, people would have said they prefer hash rate controlled sidechains to federated sidechains. like Liquid and Rootstock. But I think if you ask them now, they'll change they will swap their view. So now they're like, actually, the federated sidechain is much less likely to create a problem for Bitcoin, and it's much less likely that the collection of dozens of exchanges would have a conspiracy and try to steal the pegged coins because we know who they are. And it would involve a massive conspiracy, and there'd be legal problems and stuff like that, right? Whereas if miners do it, it's kind of anonymous, and it's more difficult to do anything about it. So you don't know who to blame, for example, right? So I think even the discussion changed the perception, and like it's instructed to look at what people don't like about it and why, because maybe there's a way to like make a safer type of sidechain.
So how big a part of the discussion and how much influence does the infighting on Twitter have on Bitcoin's development, like the ATIQ people and all the stuff that we talk about, and like
well, I mean, I think there's like a mixture of people. So, some people will just react like, don't change Bitcoin. It's like sort of more philosophical, right? Like
based from conservative.
Well, I mean, it's true. Actually, I went to some kind of like private meeting, like a bunch of like investors and a few tech people, just like general discussion for a weekend kind of thing some years ago. And like a question I asked for the like Bitcoin holder or investor or fund manager type of people is like, well, what features would you value most from the technical side for Bitcoin? And their answer was surprising, which was like, just don't break it.
Yeah.
That was the number one feature, right? And so that's very interesting, right? Because they didn't even care about Lightning, actually. It's like, it's like payments. No, they care about investment.
Oh, that's good to hear.
So like if there's something like about key management or vaults, so like, okay, like now I'm listening. But if it's like about micropayments, I don't really care about it. So no, I think like really you want a bit of both because, ultimately the value proposition of Bitcoin is the ability to, do the censorship resistant payments, and we can get more of those by using something like Lightning. So if we can make Lightning better, that also helps the kind of value proposition. And it also frees up space for cold storage, which is good too. So, yeah.
All right. So what's this this unavoidable bug that is in the code that needs to be fixed for the hard fork in like 2050 or 2090 or what is that called? I for the name escapes. 2106. Yeah, that's the one.
Yeah. I think it's kind of like, the year 2000 bug.
Yeah.
Like some counter wraps around because it's a 32 signed 32-bit integer, right? So like, but I don't think it's an issue because it's like, so many decades away that you can just make a technical hard fork that was fixed, like 5 decades before it could become an issue. And then nobody's running like 5 decades old code and nobody notices, right? Or something like that. So I think it's very simple to fix.
Okay.
But it's like a technical curiosity that like, well, we can't fix that with a hard fork.
Okay. So everyone is sort of relying that we will fix that just because the sheer amount of time that we have to fix it.
I mean, I think the thing is, if you make some incompatible change, it's very hard to coordinate that everybody would upgrade and then nobody would accidentally like get left off the network or something. But, if it's coming in like 100 years, okay, like they're not even in a rush to fix it, right? Because, as long as you can fix it so far ahead that it's implausible, anybody would still be running that old software, then it's pretty easy to fix.
So how are you enjoying this episode so far? Before we dive back in, first a little bit about our sponsors. First up, Wasabi Wallet, the privacy by default, open source, non-custodial Bitcoin wallet with CoinJoin built in. It's the easy to use, comprehensive, affordable way to make your coins private. And the best part is they've been making huge improvements to the app. They're really focusing on the user experience, adding advanced features for power users. They just keep getting better. You send your coins to your Wasabi wallet and they get combined with loads of other coins using the Wabi-Sabi protocol, so they're private on the other end. Your tracks are covered, so you can work on expanding your freedom footprint without worrying about your privacy. So check out wasabiwallet.io and download Wasabi today. Next up, Orange Pill app, the Bitcoin social layer app for iOS and Android, where you can stack friends who stack sats. You can connect with your favorite Bitcoiners on the app, make local connections, and even connect with Bitcoiners around the world. And a big feature on Orange Pill app is events. You can see what's going on in your area and connect with Bitcoiners around you. I've been to multiple Orange Pill app events, and they brought Bitcoiners together from all over. The best part is, you know it's high signal. There's no spam on Orange Pill app because everyone pays to be there. It's just $3 a month. So download Orange Pill app on Apple or Android and get connected to the Bitcoin social layer. Next up, our new sponsor, the Bitcoin Way. Their mission is to onboard, educate, and remove barriers to taking self-custody of your Bitcoin. They cover everything from cold wallets to nodes, no KYC Bitcoin purchases, inheritance planning, payments, and more. Whether you're new to Bitcoin or you're an experienced Bitcoiner looking to expand your freedom footprint, or you know someone who this sounds perfect for, the Bitcoin Way has something for you. They have a skilled team, well-versed in the Bitcoin space, and their goal is to make all the complexities of Bitcoin as straightforward as possible for everyone. And the best part is, you can get started with a free 30-minute call with their team. Go to thebitcoinway.com/contact for more info. All right, back to it. Don't forget to like, subscribe, and brush your teeth.
So how is Liquid doing? Like, how is Liquid adoption doing? Like, what's the developments? Like, what do you see there, and what do you predict in the future?
Yes, I mean, unlike it's mostly kind of organic. So I guess like a little bit analogous to Lightning, there are different types of startups involved, right? So people are building like the Lightning protocol, and then the LSPs, and then, applications and games and things like that. So there's that kind of thing happening with Liquid, with multiple startups building on it. And, some of them are organic and just, you never hear about them. And then they have a product nobody knew, and it's in market, and now people are talking about it and using it. So a number of things like that have happened over the last year. So, I mean, one is SideSwap, which is a Liquid wallet, and a kind of non-custodial central order book. So you can, from your wallet, you can place a limit order to buy Bitcoin like below this price, and you sort of sign part of the transaction and you give it to the server through the app. And now you can switch your phone off or your desktop off or what have you, and somebody can come along and decide they want to sell it to you, and they'll give their partly signed part to the server, and the server just combines them, takes its commission, and sends it to Liquid Chain to sell. And so it's a kind of trustless limit order. So it's a way to do trading or buying or selling without custodial risk. And actually, they're integrating hardware wallet support, so you could even you could use a web experience to like click on the prices you want, and you scan a QR code, and then you approve the transaction on your hardware wallet, saying, yeah, I want to buy Bitcoin at that price, and I have some Liquid Tether in my hardware wallet. And when it transacts, it basically funds move between two hardware wallets. So it's an extremely safe way to do trade without the kind of, Mt. Gox, FTX, Quadriga, all the kind of exchange custody risk. So that is very interesting. And they even have, so on Liquid, there are two types of assets. There are like Liquid Bitcoin and Liquid Tether, things that are just peer-to-peer transferable. And then there are there's an option to make an asset a security. It's called AMP, a managed asset. And so the thing there is you can't like receive it or send it to somebody who is not like whitelisted. And the way you get whitelisted is you enroll like with an exchange or something, right? So yeah, the way that you interact with it is like that. But once you are whitelisted, it's curious because now you're transacting something which is like a licensed registered security, but you're transacting it in a very peer-to-peer feel, right? I can like, send somebody 1/100th of a share as a gift, or they can like, give me 10 euros for it in person, and I can send it to them, or I can like agree an OTC price and swap it with SideSwap, or I can put it on the market on SideSwap, all in a sort of permissionless way, but still like compliant with securities laws because of the whitelisting. So it's a kind of novel kind of merge of unlikely things, right? Which feels like very permissionless, but like behind the scenes permissions. And it's very simple from the blockchain, like from a Liquid blockchain point of view, because all it sees is a multisig.
But all these things, aren't they like these are sort of bridges between the Bitcoin world and the fiat world, as I see them.
Yeah, that one is. I mean, another example is, I mean, there are some like startup derived things, and there are some user behavior derived things. So one user behavior derived thing is dollar cost averaging. So we came across users who were dollar cost averaging on Liquid because the fees are low. And if they're, buying $5 at a time, like if you withdraw from an exchange, it's expensive, right? And so they're dollar cost averaging on Liquid, and then they'll get to a target, like 1/10 of a Bitcoin or whatever the threshold is, and they'll take it off onto cold storage on the main chain, and they'll do it again. So it's a kind of way to do something frequently and like amortize the cost of going to a UTXO. So that's kind of one kind of use case. And the other one was the bolts, like liquid atomic swap. So sort of connecting Liquid and Lightning, which was also like organic, right? I mean, a startup decided they had a problem, and like within a week or two, they had a solution. So it's quite interesting things. And, they're continuing sort of people issuing different assets on it, more wallets, adding Liquid support. So there's a new one that was announced at this conference called Wolby, which is a kind of a super app. So it's a Bitcoin wallet, and it's a Liquid wallet, and it's a rootstock wallet. And I think they're adding Lightning too. So it's kind of all Bitcoin related layer 2s and the main chain in a single wallet. Green is a bit like that because it has, it has Liquid Bitcoin, and more recently we have the beta integration of Lightning as well. So kind of all three. But the Wolby super app is even more, right? Because it includes rootstock and plans to go between them.
But all of these things, like, do they exist post hyperbitcoinization? Like, if in a fully Bitcoinized world, is there a use case for these things still?
Yeah, potentially. I mean, I think that the layer 2s are sort of a bit like TCP/IP, right? So there's sort of specialized protocols on top for different like application domains. So I think, if Lightning is specialized for retail payments, then Liquid is specialized for like maybe trading, has some additional confidentiality because of confidential transactions. And I think another configuration that might come about in the future is because core Lightning works on top of Liquid as well. So you can have like Liquid Bitcoin channels. And then instead of rebalancing Bitcoin Lightning channels with Liquid, you can have Liquid Bitcoin channels, right? And so, for the risk, if the amounts that are involved in Lightning are very retail, like not huge amounts of money, right? Like maybe, the phone is more expensive than the Bitcoin on it kind of situation.
Yeah.
Then maybe it makes a good deal of sense to anchor Lightning channels in Liquid, which is kind of layer 1.5. And then that frees up even more space from the main chain for cold storage because you don't get all of the Lightning, transaction anchors and stuff like that. And I think Liquid's capacity is sort of similar to Bitcoin's because the blocks are 10 times as fast because every minute they're the same size, but the confidential transactions are about 10 times bigger because of all the crypto stuff. But, I think that would be an interesting trade-off, and the sort of thing that somebody might, like Bolts did, somebody might adopt in, a future prolonged fee spike or something, right?
Yeah, your panel about when 100K, the nice provocative title, lots of bullish energy in there in terms of the time frame and when the fiat price is going to go up. But what do you see at the moment as the biggest long-term threat to Bitcoin?
I'm not sure. I mean, for people who were involved, 2013, 14, 15, banks didn't want to hear about Bitcoin. Like if you were a business development person sent to talk to banks, they would tell you before you go into the room, don't use the word Bitcoin, right?
Yeah.
And that all changed, Then every bank on the planet had a blockchain R&D lab, right? And, come forward a few more years and they're all vying to provide Bitcoin related financial products. And so I think in that same kind of time frame, like 2013 to 2015, a lot of people were quite worried, and even before, about regulatory banned, like, China bans Bitcoin, but like thinking, well, maybe Europe and the US will also ban Bitcoin. And that would be a risk, right? But I think, that risk has receded a lot because, the regulators have regularized, Bitcoin as property legally. I think a lot of technical risk has receded, like, Bitcoin's quality assurance has improved, the rate, the changes have become more conservative, and it got through the block size wars and showed that, the investors ultimately were able to enforce the immutability despite a big array of financial interests wanting to change it for the economic benefit of startups, I guess, ultimately. So I'm not sure, I think the risks have receded on most fronts. So I'm not really seeing a big threat. So I'm not sure. Yeah, it seems like, of course, a different kind of threat, I think, or risk could be that Bitcoin succeeds, but emphasizing the investment asset use case and losing some sort of momentum on bearer censorship resistant self-ownership of keys. And I do think it's potentially a problem if too big a proportion of Bitcoin's economic base is held by ETFs with corporate lawyers and fund managers, fiduciary duties and stuff like that. So, ultimately the value is the use case, like the digital gold, the cold storage, the ability to spend. That's the thing that banks can't compete with. So, the banks offering financial products is kind of like, VCs buying or investors buying internet stocks because they thought the permissionless chaos of the internet would be popular. They might not have liked the permissionless chaos, but they could see they could make money from it, right? So you don't want the guys that are riding a trend to break the trend or erode the permissionlessness, right?
But this is a slightly more philosophical question. Can institutions actually own Bitcoin though? Because not your keys, not your coins, and custodial, the real possessor of the Bitcoins is some guy or some guys with a multisig thing.
Yeah.
So how do you see that the relationship between ownership and possession in the future, and is owning Bitcoin more than just keeping a secret? How do you see that playing
it's
out?
Certainly an indirect and more fragile ownership claim, right?
Yeah.
So, if you assume there are very much more credible custodians, already Fidelity I think has a custodian service that's probably one of the highest tier, but there are other fairly high tier established financial players that provide Bitcoin custody for a fee to corporations, but it's still indirect, right? Because if you're an individual and you can get access, if they sell to individuals or you're a company and something happens, like a court makes a judgment against you or law enforcement makes a judgment against you, then the custodian doesn't listen to you anymore. They listen to the third party and freezes your assets, right? So then, well, did you really own them? Well, kind of. You had a right to request them, which they have discretion to refuse if there's some overriding claim, right? So yeah, you don't really have full possession of them anymore. That's the risk.
Yeah, and also if a custodian feels threatened by a government or whatever, the one guy or the 3 out of 5 guys can just buzz off and go somewhere else and live their lives without them ever knowing.
Yeah, I guess probably the big custodians have, because they are custodying other things which are hard to undo, like maybe artwork or physical vaults for valuables, and they have developed over, centuries, quite good, what do you call it, cross-checks and governance and procedures to make sure that it's difficult for a small group of insiders who get corrupt. Because banks do have tellers that go rogue and people that try to steal. So they try to make a lot of cross-checks and controls in there to catch it early or to prevent it without a huge collusion or something like that.
Still, if this, ketchup effect thing happens and Bitcoin 100x's.
Yeah.
Like, so all of a sudden those 10 Bitcoins are worth more than that Mona Lisa type pen. Like,
well, I mean, that's a case for like the vault situation. I mean, the smart contract kind of script vault, which is that, the day-to-day operations, the people operationally in control, can devault and then spend money out of the devault, or maybe manage a kind of warm wallet.
Mm-hmm.
But, there will be other people, a much wider array of people, potentially including people with coins in the custody who can like blow the whistle, like, hey, these coins are moving and nobody approved them, and have like a week's time or something to cancel it and send it, somewhere much colder, which is like maybe extremely inconvenient to access. And, that would be impractical for a day-to-day service, but is a fallback if something weird happens, right?
But that's not in place now. Like,
no, it isn't. I mean, but I think that's one of the reasons we probably should try to build them, like either using the pre-signed transactions or with some kind of vault, some kind of covenant technology to build them.
We as in?
Well, I mean, like people who build stuff, like startups, technologies, companies. Yeah.
So there's a market. You foresee a market for those kind of services?
Well, I mean, as somebody who's like, being involved in like the technical part of custody and thinking. So if you actually do something, then you start to think much more clearly and pragmatically about the risks.
Yeah.
So if you think even on a personal case, you make a steel backup and you put it in a home safe, and then you think, well, what if I went away for the weekend and somebody swapped the safe for one that looks the same, and I don't notice for a while, and then I find I don't know the code, and I'm pretty sure I haven't forgotten the code, and then I realize they've swapped the...
Or they just open the safe and look at the words. Like,
yeah, well, I mean, like that's assuming they cut. I mean, I think typically consumer safes are actually not that good. So a skilled safe cracker can open them anyway, like bypass it. But even if you assume it's good quality and they can't bypass it, they can just take it and swap it, and maybe you don't notice, right? So if you start thinking about some of those things, then it's the physical backup can be taken. That's the problem, right? So what would you do about that? Well, you need to be able to cancel it, and then you need this kind of digital vault. And then if you had that extra technology, you would have an answer. So you got security cameras everywhere, and you see that it happened. Now, if it was today, it's too late. You saw them get stolen, so what? They've cleared on a chain and they're gone, right? And you can't undo them. But if you have a vault process, you can undo it. You have a week to like take it back, right?
So, but like, I mean, steel plates and all whatnot are they're sort of the norm now. But really, what is it? It's just your imagination that counts when it comes to storing Bitcoin. I mean, a private key is a set of characters, and a seed phrase is a couple of words. So, say you hide them in a poem. And you store that poem in 3 different locations in 3 different countries, and nobody even knows that it is a seed phrase, and it's impossible to tell. I mean, it's literally just your imagination setting these boundaries for what's possible. And I think the Bitcoin space is sort of like, okay, this is the norm now. We're doing steel plates, and where it's blatantly obvious that the Bitcoin are there because it's a steel plate with a seed phrase on it. So like, it's not hidden at all. It's like a gold bar.
Right. Yeah. I mean, it is. Yeah.
So how do you see that? Did you see like other developments in the like Bitcoin storage space? Like, are people using their imaginations enough?
Yeah. I mean, I think it's, certainly people have tried lots of different strategies, including, having a password and memorizing it, or splitting things up and storing them in different locations, or trying to hide things very effectively. And I guess there's always a trade-off between, hiding it too well, so that, if you have an accident, then people can't find them or something. And that's probably happened a couple of times in the last few years to people who unfortunately had an accident and people couldn't figure out like the backup strategy. Or I think the other thing that can happen is people can get like very creative and make some kind of complicated trail to solve for themselves, and then forget parts of it because they didn't try it. So I think it turns out that people's memory is a little bit fallible if they don't frequently exercise it for a few years. So I think that's a trade-off, right? And I think for companies like somebody doing like a custodial service, it's a little bit more complicated because they have to manage the change of staff. So somebody leaves for another job and you need the security to remain. So you can't like place, you have to make it somehow physical so that, you know, there are enough controls that you can like have somebody leave, there's a documented standard, and that person doesn't take part of the secret with them, sort of thing, or something, right?
Well, I think the only other thing I've kind of got on my mind is with some talks about threats and things that could go wrong. What are you seeing positively about how Bitcoin is doing in the world? Is it doing the thing that you thought when you first heard about it? Does that make sense?
Yeah. Has your how much has your view changed over the years of what this thing is?
I mean, my view is basically the same since, like, I don't know, 1995 or something with electronic cash, right? So, you know, David Chalmers developed this kind of cryptography for electronic cash in 1985 in his PhD thesis. And he's still around in the crypto space, but he's an older guy now, right? He's a very clever cryptographer. But I think in the mid-90s, there was a startup in the Netherlands that David Chalmers started to, you know, commercialize and make available electronic cash using this technology. And effectively, in today's terminology, you would call it like a stablecoin, because that was like, you know, not dollar denominated, but euro or something, right? And, but yeah, so I think the thing that, like, at least the cypherpunks thought was exciting about that kind of technology was the bearer finality of it, right? That it's, you know, it's digital, but it's physical too. Like, I own it and only I own it. Nobody can take it off me. Nobody can censor me. Nobody can prevent me transacting. And maybe nobody can even kind of detect sort of who paid who, because that technology was extremely private, right? And so to those people, that was extremely exciting. And then the concept of smart contracts involving bearer finality was extra interesting because it meant that a contract was final. You know, if there's a smart contract that says, you know, you get paid when this event happens or when this task is completed, and it's it's machine verifiable, then the fact that the payment is bearer final means the contract is final. So you can't dispute it. So it's sort of extremely efficient, low cost, sort of decentralized, reputation based commerce on the internet, kind of in a gray market, fully permissionless and global and anonymous, right? So we thought that was really interesting like the people on the cypherpunks list, really interesting. And like Bitcoin realized it, right? So, you know, here we are and it's working. I mean, it's not quite as private as that tech was, but it's, that had a side effect of being centralized and vulnerable to that company shutting down, and then the central database was lost and it was all gone, right? So, yeah, I mean, I think the reaction to DigiCash winding down and seeing that fail if you held some of the coins was, wow, that central point of failure is really bad. It needs to be decentralized. Like, how would you do that? And then, you know, there are all the discussions in the, I guess, late 90s, early 2000s about, you know, how could you possibly build a decentralized electronic cash? And like there were things that sound like vaguely similar to Bitcoin, like about mining and proof of work and smart contracts and, you know, Byzantine generals problem, all these discussions, but nobody figured out how to do it. And so Bitcoin really made it happen. So yeah, I think it's great. Like, you know, and like I think that it changes people's viewpoint who come in. Like, you know, the attraction of the kind of pure mathematical elegance of having a piece of digital property that's yours and can't be taken from you, can't be eroded, can't be seized, can't be, you know, frozen, cancelled, undone. It's like super cool, right? People get their head around that. Of course,
it wouldn't be here if it wasn't.
Wow, that's amazing, right? And so people are just like, it's quite interesting. I went to Paralelní Polis, you know, in Prague, and they have a coffee shop in the ground floor. Yeah, and you have to buy with Bitcoin. And so, you know, we were talking to some people after the event they organized, and they were like, yeah, their first interaction with Bitcoin was they came into the coffee shop to buy a coffee, and they knew nothing about Bitcoin. They just wanted a coffee, right? But after they learned about it, they got like very philosophically interested in it, right? So so basically, it doesn't matter what angle you came from it, like whether it's a friend or as an investment or as a, you know, casual payment. like just how it works is super interesting. Like, you know, the mind virus that keeps everybody super enthusiastic for years and years.
Yeah. Tell me about it. So what was that? I just had something on my tongue. Yeah. About ownership. I mean, since we've established that owning Bitcoin is nothing but keeping a secret, how do you prove ownership, like in a ethical sense? I mean, of course, the legal systems are flawed and whatnot, and they can prove all, quote unquote, prove all sorts of things that aren't necessarily true. But like from a strict, you know, information technology perspective, how do you really prove that someone owns a Bitcoin, since it's just information in someone's head at the end of the day? Is it even possible?
Well, I mean, I suppose a close analog is if they're willingly proving, they could sign a message or spend to themselves, and that would be pretty convincing, right?
Yeah, I can think of a case where that would have been the right thing to do to prove you're a certain person, but it never happened. But still, if they refuse to and just use the boating accident excuse or whatnot, like how?
Yeah, I mean, there's nothing you can do to prove it, right? I mean, it even happens in some unrelated to Bitcoin court cases where people have encrypted hard drives.
Yeah.
And, you know, there's some investigation, their equipment is seized, and the court demands that they decrypt the data, and they refuse.
Yeah.
And like basically after some kind of prescribed legal limit, they have to let them go because no decryption, no evidence, presumption of innocence, and like some kind of prescribed legal limit on holding people for contempt of court. If they refuse, you have to let them go, right? So I think that's kind of a precedent, right? If you can't prove it, like what are you going to do, right?
Yeah. And even like if I do an on-chain transaction to obviously buy a cup of coffee, and there's a note in it saying you bought a cup of coffee and you bought it here, and at this point, like still to me, even that is impossible to actually prove that I made that transaction. It could have been anyone else keeping the same secret, right?
Right. Yeah. Yeah, it's true. Yeah.
Yeah. So,
well, I think it's important to keep identity out of the blockchain.
Yeah.
And, you know, some people got excited about digital IDs and like having kind of KYC certificates on chain, and Ethereum even got on the train. What was this? The soulbound tokens. I think it's another word for a digital certificate, basically. Make a lot of sense to me. But I think you want to keep that stuff as far away from the blockchain as possible, because banks particularly, you know, the technologists that come from the banking world, they're used to the concept that the, you know, people could lose their online login. And so as long as they have, you know, their passport and a utility bill, that individual is the owner of the asset. And so they kind of just gravitate by instinct and momentum to wanting to like put identity stuff in a blockchain and make it a condition of the spending, right? It's like, well, the guy with this passport or the guy with this fingerprint or something. I'm like, no, like it should be, it's bearer. It's a bearer asset. Like it's a bad idea to put identity anywhere near the blockchain. And like, so I don't even like people making decentralized IDs, because if they're in a blockchain, then sooner or later somebody's going to use it as a spending condition. So like, so keep it away from the blockchain, if you ask me.
So in the same vein, like, do you think we'll see CBDCs playing out like as a real thing? I mean, are they already? Like, what are we living in? What are we looking forward to?
I mean, that is dystopian dark stuff, isn't it? It seems like the sort of Europeans and the American like central bankers are getting FOMO for, you know, the dystopian Chinese kind of social credit score, freeze your money, like, you know, disfavor you financially if you don't like conform kind of thinking. And, you know, I think they kind of want the microeconomic control, right? So, you know, they printed so much money that it kind of lost control of inflation, and you like the levers they have to influence inflation are super indirect, right? So they put money into the system and it just flows into banks that lend less or something.
Yeah.
And so, if they could reach into your pocket and say, well, you got to spend this money in a week or we're going to take it back, well, you're only allowed to spend it in this way, they would love that because it'd be kind of like microeconomic control, but it's like extremely dark kind of concept. So I'm just hopeful that democracies will just like say no.
Yeah, the term programmable money is wrong. Like programmable money is the same thing as programmable people. That's what it is, right? Because people use money, like it's just us at the end of the day.
Is Bitcoin going to help us avoid that?
Yeah, well, I mean, I think there are some countries which have tried to phase out cash, like to go cashless, or even some European countries that have placed legal limits on cash transactions or taken like 500 euro notes out of circulation, and other countries that are still heavily cash, like Malta is very heavily cash, Switzerland is very heavy cash, but Switzerland has like 1,000 franc note, which is worth like double that or something, and they use it, like Switzerland has, I think, so many 1,000 franc notes that there is like about 6,000 or 7,000 francs worth of 1,000 franc notes, or like 6 or 7 notes per man, woman, and child in the whole country. So just imagine the amount of like high denomination currency they have floating around in companies and individuals. It's very cash like outlook. But yeah, so if they try to outlaw cash like by policy and regulations, then Bitcoin is a natural outlet, right? Well, we have global bearer Bitcoin electronic cash. So what do we care? I mean, we still care that you don't like make money a dystopian, like fiat money a dystopian control point, but we have an outlet, a safety valve, which is we can use the bearer Bitcoin, and there's basically nothing they can do about it.
Yeah, like the banning of cash in Sweden, or like going cashless, was at least played a part in why I made the decision to leave. And like the cash is much more common in Spain and the Mediterranean countries in general.
Yeah, I mean, I was always thinking, like even before like Bitcoin existed, that you should really use cash, even if it's inconvenient, on principle, any way you can, just so that, governments don't get the idea that, well, everybody's using debit cards anyway, we could probably phase it out, right? So if, if I use cash for like hotel, for taxi, for train, for anything, if a lot of people do that, it becomes difficult for them to change.
Another thing about Sweden that I brought up with all the other guests this weekend is that I talked to Christian Ander, the CEO of BTCX, if you're familiar with that exchange. It's the oldest Swedish exchange and one of the oldest in the world. Overall, over the years, they've had over 300,000 customers. And there's another big exchange as well. And of course, there's some overlap. But then there's also like people buying from international exchanges and getting their Bitcoin some other way. So if you assume that 500,000 Swedes have Bitcoin or have access to Bitcoin somehow,
that's quite a lot, right?
That's 5% of the population. That's 10 million people in the country. So when I think about that, it's like, okay, so 5% of the population have the ability to pay other people in Bitcoin right now. And the entire population has the ability to receive them because, within a minute.
Yeah.
So to me, the conclusion I draw is like, this economy is already here. It's just below the surface. And it's just, if shit hits the fan even harder than it has, like, then it's just bound to pop out and just happen. Like, how do you see that? Are we close to this boiling point, or like?
Yeah, I mean, I was describing it as a bootstrap threshold, where even like where there's enough people that own Bitcoin that even if all of the sort of KYC official businesses had to stop immediately, that it would keep going with the gray market. Because, it's kind of like marijuana or something. Now, if enough people do that, you can, ask a friend of a friend, like within a social network, you can find somebody to trade Bitcoin, right? So, and that's clearly the case now, right? You're in Bitcoin, but if you're not in Bitcoin, you probably know who to ask for, who might know somebody who could trade some Bitcoin for cash.
Yeah. It's the Kevin Bacon number equivalent, like.
So I think like clearly it's bootstrapped and like potentially even internationally, right? Because there are like unofficial international swap markets for delivering cash, right?
And that's the experience I have with traveling around to all these conferences and meetups and stuff. Is like that it's still small everywhere. Then you have to take into account that not every Bitcoiner wants to go to a Bitcoin meetup or a Bitcoin conference. It's just a small portion of us that do these things. So, but even those things they're small, but they're everywhere, literally everywhere. So insanely bullish.
Well, I mean, I think the million UTXO or like Bitcoiner situation is like insanely bullish because you think like, well, could we get to 10 million? It's probably not like economically possible.
No.
Like, could we get to 2 million? I don't know. Like the price might get pretty high before that could happen, right? So like, it seems like we're not that much more adoption without any like institutional buying or US spot ETFs or anything for just, things to get crazy, right?
Weird. Yeah. Because it's not that you double the amount of whole coiners and price doubles. Yeah, it's exponential, right?
Yeah, it's much worse. Yeah, and it's getting worse over time because the
by worse you mean better.
yeah, better. Like I mean the liquidity, like the number of coins that are available to get bought on exchange are like shrinking, right?
Yeah.
So that means because there's some kind of metric people try to put like, well, if $100 million of Bitcoin are bought, how much does it put the price up? And like, it's going to put the price up a lot more if there are very few coins left on exchanges, right?
The show is also sponsored by Zellox. That's XELLOX. They've developed the excellent Yokis seed plate kit, the solution against everything life throws at you, including fire, water, corrosion, and pests. The Yokis package includes 3 stainless steel plates and a pen-sized electric engraver so you can write your seed on metal just like writing on paper. And they have big plans. They're developing a next-gen hardware wallet too. But for now, you can order the Yokis to safeguard your keys in a safe and convenient way. Check out Zellox at zellox.io. That's XELLOX.io. And finally, we're also sponsored by bitcoinbook.shop, your source for Bitcoin books in over a dozen languages, including all of Knut's books. Their mission is to translate great Bitcoin and freedom-oriented books into as many languages as possible, while also publishing original titles to get even more knowledge out there. Use code FOOTPRINT for 10% off your purchases at bitcoinbook.shop.
I think this has been a great talk, great discussion, talked about some kind of downsides, the things that are risky going on right now, but also incredibly bullish at the end. So is there anything else on your mind in the Bitcoin space these days?
Well, I mean, we're like at Blockstream, we're interested in like anything that has potential to improve Bitcoin. So we're kind of got our fingers in lots of stuff, like layer 2 and manufacturing miners, but also simplicity, which is a kind of sort of long-term ossification technology, if you like. It's that the kind of technology arc started in like before Blockstream in like 2012 IRC discussions. And so that is a sort of low-level microcode self-extensibility for Bitcoin. And the idea is because of the formal semantics and formal proofs that it could be a more secure, dependable kind of script than the current Bitcoin script even, and self-forkable. But, I think something like that is like, probably 5 years out at least. But it is interesting to consider that there is, a very credible, serious engineering effort that could, as a strong contender to get us to ossification and like mean it, right? Like the last soft fork, we don't need to do like the kind of soft forks we do today after that. That's like, to me, an extra bit of comfort because I feel that, the drip of ongoing soft forks is like a little bit of persistent risk that we'd sooner like, find a way to either modularize, like, so people can do things in like safe contained areas, or finalized Bitcoin script. So like it does what it does and you don't need to change it anymore. And Simplicity could do that.
Is it inevitable that you change the incentive structure somewhat when introducing any soft fork? Like,
yeah, I think so slightly, because I mean, even the fact that it, like any previous SAO enables more efficient Lightning. Okay, so maybe Lightning uses less block space per transaction or changes. Like, so they're all going to change something a little bit. Like maybe vaults change the cold storage behavior, or they probably like subtle small things, of course. But yeah.
Yeah, always a risk. Adam, thank you so much for coming on, and have a good whatever the rest of the conference is.
Yeah, thank you. Thanks for having me on.
So what did you think of that episode with Adam back? We really enjoyed this one. Adam clearly understands everything he's talking about, even if he's not Satoshi. Can't blame us for thinking he's a likely candidate. Anyway, let us know what you thought about this episode. You can send us a boostergram on Fountain, leave us a comment on YouTube, or get in touch on Nostr or Twitter. If you're watching on YouTube, don't forget to like the episode and subscribe to the channel. Our show sponsors are Wasabi Wallet, Orange Pill app, The Bitcoin Way, Zelox, and BitcoinBook.shop. Check out their details in the description. That's all for now. See you next time, and thanks for listening.